Sure, that I have a recording out there. Mitch, are you good? No. Sure? No, I'm not trying to interrupt. I just want to make sure that I didn't skip something.
I asked a dumb question.
There's no dumb
Can you
question.
depreciate a gift?
Can you depreciate a gift? What's the gift?
A vehicle.
So if someone gifts a vehicle to
For business purposes.
for business purposes, and the vehicle then is there, you have a cost of the vehicle. The vehicle can be depreciated at the fair market value that you then put the value of the gifts. Okay, but you have to be using it for a purpose. But it would go on your books at fair market value. But here's the tricky thing.
Because it's listed as an asset of the company.
It's listed as the asset. Yeah, you'd have to declare it as an asset, right? And it was gifted. It would be put at the fair market value of the date of the gift. Okay. The tricky part is that if you go to sell it, your basis in the asset is actually zero. So you're making me think on that. So your fair market value, if you're depreciating it, your basis is already zero. And if you're depreciating from the fair market value, you're going to be taken to negative basis. I might retract what I just said. Because your basis is already zero.
Would it make a difference if the car was worth more or less than $50,000?
Yes, no, that-
Because that's the individual gift?
The threshold for a
The
gift.
threshold for a gift is $15,000, right? So the person that gifted it to him is going to pay tax on it,
If it's more
but not you, right? So if the person that gifted it to you, if they gave you a $30,000 car, the fair market value is going to be obviously $30,000. You didn't pay anything. I would have to look into that. I think the value of the car is going to be recorded on your books at something because it would be worth more than the gift value of the car, but you didn't pay anything. So that's what I'd have to look into is what do you record the value at in order for you to be able to depreciate it. Because if you can't record it at a value, then you can't depreciate it. So we'd have to look at what that would record at, because it is an asset. So it's going to have a value of some sort, but the basis is what we're looking at. So if that's a real question, not just a hypothetical, I can try to find the answer for you.
Well, it's a hypothetical.
It's a
hypothetical real question.
Okay, well, I will hypothetically try to find you an answer. Okay. But that actually is a good question. So, okay, so credits. For some reason, you guys don't like credits on the final. So I will give you a heads up. You guys don't like it. I don't know why, because to me, I honestly feel like this is the easy part of the test. But I have like 8 or 9 handouts right here that I'm going to give you about credits. I'm going to hand them all out because each one shows you how to do another credit. They're not going to be 8 or 9 questions on the final about credits because there's probably same number of questions you had on the midterm. I can't remember how many there were, 30-ish? 35, there we go. All right, so there cannot be 9 questions on credits, right? There's like 6 chapters on the, so there can't be 9 questions on credits. But to me, earned income credit's one of the most important, so we're going to talk about that. And so it's education credits to me that I believe, and child tax credits, so we'll talk about those. But I want you to see these so you guys can understand that they should not be hard things to calculate, but they are very important credits. Okay, so the big picture talks about these people. They have 2 kids in college. One's a freshman, one's a junior. One of them, they pay for her tuition and fees. She has a scholarship, and they have room and board. The other one, they paid his tuition plus room and board. They give their AGI, $158,000, and they want to know what their options are with regard to education credits. They were told that their income is too high. All right. So the first thing, and we have already talked about this, but this just gives you a visual of it. What's the difference between a tax credit and a tax deduction? And I've told you guys a tax credit is always better than a tax deduction because a credit's taking it right off. A deduction is only reducing your taxable income. So this just gives you an idea of how it, so a tax benefit received for a tax dependent depends on your marginal tax rate. Example, you have a $1,000 expenditure, 25% tax credit compared to a tax deduction. All right, so a benefit of a credit, $250 credit and then they give you the difference in the tax rate. Here, if it's a deduction, you get nothing. That means you had nothing that was taxable. So if you don't have anything, then you get nothing. Here, 12%, you only get $120 benefit, and here you would actually get a deduction.
What does MTR stand for?
Marginal tax rate. So if you have a 0 marginal tax rate, then you would get nothing from a deduction. All right? If you have a 12% marginal tax rate, you would benefit from $120 deduction. And if at 35%, you would actually benefit more from the deduction than you would a credit. Right? So most of the time, think of who pays the 35% tax rate, all right? Extremely high income. So most of the time, people benefit more from a tax credit. And then refundable versus non-refundable credits. All right, so refundable credit means that you can get that credit even if you're not getting any money back. If you have no taxable income, you can still get that credit. The biggest non-refundable credit there is earned income credit. All right, you can get money from an earned income credit even if you're not getting money back. The other one is there is a small part of the child tax credit that can be refundable, not non-refundable, but can be refundable. Non-refundable means that you get that credit to the point that you owe money, all right, or you're getting money back. After that, if you have no taxable income, then it just zeroes out. You don't get it. And we'll see examples of that.
So you can get money when you pay money?
It takes off what you owe or it takes off what your base is, okay? So credit can only be used to offset a tax liability. So if I owe, you go through, and it's not looking at what I paid yet. It's just looking that my tax liability is $7,000. Okay? I have one kid that I get a child tax credit of $2,000 for, so over the 7, they knock that down to 5. Then I have 2 kids that one's in college, one's over 17, that's another $500 each. Now I'm down to 4. All right? However, if I only had a tax liability of $2,500, I would get $2,000 for the one kid, $500 for the other, but the other $500 just goes away. All right? Because I didn't have a tax liability enough to do it. Whereas the refundable tax liability, which is the next slide, talks about all of them, that would allow me to get money back. Okay? But that I do not qualify for the refundable child tax credit. There is some that is refundable, but it's for the lower income. So here's a nice list of all the credits. Now, I did not print you a form for every one of these, and we are not going to talk about all of these. We're going to talk about highlights of some of these. So, earned income credit we're going to talk about. The Affordable Care Act is in here. It is still there, okay, because they haven't done anything to take it away. It's just not, I believe the change is it's not necessarily as mandatory as it was. All right. Then those are refundable. So 3. They list 3. I actually thought, and they don't show it on here. Oh, here we go. The child tax is refundable to the extent of 15%. So there is part of it. I was like, where's it at? So there is part of this one. We'll come over. General business tax credit, there is a ton. That's why it makes this list so big. So there's a general business tax credit depending, and we're going to talk about it. We are not going to go into every calculation of every detail on it, and you will not have to go into every calculation of every detail on it, okay? But you're just kind of, we're going to go into what some of them are. There's a credit for elderly and disabled, okay? Lower income again. Adoption expense credit, child tax credit, we're going to go into that. Daycare expenses, education, energy, certain retirement. If you're making low income but you're still putting money into a retirement plan, you'll get a credit for that. Some smaller health employment, and then the child tax credit here to the extent that 15% of the taxpayers earn income in excess of the $2,500, only to $1,400. So depending on what your income level is, up to $1,400 of the child tax credit can be refundable. The rest of it can't, and it will go above the line. All right. 40% of the American Opportunity is refundable. So that is nice. If you're getting the American Opportunity, that can be refundable. But again, we're going to talk about that because American Opportunity has income limits.
Can we explain what is American Opportunity?
I will explain that for you. Okay. All right, the general business credit is first. I did not give you a printout for this one because there's just too many things. All right, it's a whole bunch of number of business credits. It's limited to net income, all right? The net income tax greater of either the tentative minimum tax or 25% of the net tax liability that exceeds 25%, and it can be rolled back. Now, when we look at what they are, there's several different things. So we got rehabilitation expenditure. So when you go in and you're making substantial changes to a historical structure, right? There's some credits that you can get into. Again, this one was repealed supposedly as of 2017. Not really sure why, but it was. So right now we cannot do this one, but it's still listed out there. To qualify, I'm not going to keep talking about it because it was repealed. The work opportunity credit. Now this one is only given for targeted individuals. So for companies that employ high-risk youth or felons, food stamp recipient, veterans, summer youth programs, and long-term family recipients, those type, applies to the first 12 months of wages paid to those individuals. The credit is based on how long the people work there and the number of hours that they work. So that's just to the first $6,000 worth of wages. There's research credit. Now this is to encourage business-related research, R&D is what we call it. So it's meant for companies. It's comprised of 3 different types: basic research, energy research, and what they call incremental research activities. Depending on the type of research activities you're doing, depends on the credit. All right, I usually just limit this one to R&D when you're looking at it. If you're doing expenditures for these activities, they need to be done in-house. So they're looking at companies that are doing research in-house. They're looking for, if it's done out-house, it's only 65%, but it has to be like under a certain activity or contract. But they're looking at like 20% is the credit. There's certain other things that you have to be done. You can capitalize over 60 months, but the target there is to encourage R&D in small businesses. And you can see there's 5 slides on this, right? So it is a big credit, but the target audience is, again, small businesses to encourage research and development. And the thing that I actually find interesting about this is that when I first met my sister-in-law, her dad owned his own company, and he just recently retired, that he's a scientist that owned his own company that went out and did like hazard testing at all these different companies. And when these big, gigantic companies had spills and hazards, spills, and all these things, he was this company that he started himself that went out and did all these different testing. The type of thing that you would see this type of credit for. So I'd be like, wait a minute, that's what, he can do this, you know, and it would always be like, that's the type of thing they're looking for. And then there's the energy credit, and basically to stimulate energy research. So it's R&D, but it's R&D in the energy field. So when I pass all those windmills up in northern Illinois and heading up into the Wisconsin area and up there, I always think about this type of thing.
So, but the windmills aren't actually doing research.
No, but the people that came up with those and the different technology and what companies. Now, if it's a gigantic company, that's not going to fit. But the smaller companies and the different things, when you see that, what did they do to come up with that? It's not necessarily, I'm not always right. It makes me think of that, all right? Some of them are gigantic wind farms, right? So are they small companies or are they corporations that put in those wind farms? I don't know the answer, but it makes me think of that because wind is obviously energy resource. So it just makes me think, who came up with that? Who put it out there? What are they doing with it? That type of thing.
So the people who invent new things with regard to solar energy,
Trying to come up, doing
they
research.
would get it, but if I buy solar panels...
That's not that. No, that's not this. That is not this. That was a credit for a long time, but that is not a credit now. Okay, then we have low-income housing credit. All right, so this credit is issued. It's a nationwide program, and it has yet to be cut, which is great. It's based on the type of property, which is dependent on how many units it holds. The credit is allowed over a 10-year period. We have disabled access credit. This is given so that small businesses can make accommodations for the credit, for disabled access, to remove barriers and to make sure that people with the disabilities can gain access to where they're at. So it's supposed to help small businesses get to the point that they can accommodate. And then this credit is for small companies to help start up pension plans, all right? So it allows them with their startup costs, and it is limited to a certain amount, and it is limited to companies that are smaller than 100 people, trying to encourage them to help their employees invest. And then, oops, I skipped a slide. And then there's a credit for employee-provided child care. All right, so there are some companies I know that provide child care, but most of them are very big companies. So this is a credit, again, for smaller companies. Now, this could be for, we're talking about individual taxes here, but corporations could also qualify on different levels for different credits. Employers can claim a credit for providing child care facilities. It is maxed at $150,000 a year. So we're talking about big companies flowing through what we're looking at.
And that's like an on-site facility?
It's usually an on-site. It could possibly be something that is right there across the street, but something that they're providing for the families. And that just talks about how it's doing it. It has to stay in place. And then this one is interesting and has been newer. Credit for providing family leave where you pay your employee to leave. So every employer has to provide an employee with 12 weeks of unpaid family leave. But here they're giving them a credit for which they pay exceeds 50% of their normal pay for at least 2 weeks. All right? And then they give anytime during up to 12 weeks of pay. And more companies have started to give a couple weeks pay, a lot of times to the spouse. And they have to be in place, and like I said, it does have to be for at least 2 weeks. All right, so we're starting with the first one, earned income credit. And of course, I'm probably going to have in additional or reverse order. Earned income credit. Now, earned income credit, luckily you don't have to calculate. But this wonderful form, earned income credit has been a pain in my butt, I will tell you that, because you rarely qualify for it without kids, but you can qualify for it without kids. And I had a return that went back and forth with the IRS for about 9 months for somebody who qualified but did not have kids. And this form right here that I'm showing you, I did not send in because the software didn't say I had to, and they wanted it. And they kept asking for it. I'm like, they don't have kids. This only has to be turned in if you have kids. And I was writing letter after letter to the IRS saying they do not have kids. Look at her income. All right? So earned income credit is meant to basically give some money back to those who are not making enough to basically live above the poverty limit. All right? So you must have earned money. That's why it's called earned income. All right? So one qualifying child, you can get up to $35.26. Two qualifying child, the maximum earned income credit is $5,800, and for 3 or more, the maximum credit is $65.5. Now that's the most you could get back. All right. So go ahead.
I didn't get that. So you supposed to make, let's say, 3,500. You get 3% of 10,000.
No. That's that's the most you could get back. Like that's the credit you could get. You could get a $3,500 credit.
No matter how much you do.
No. I'm going to show you that. We haven't got there. Okay. So it's phased out based on how much money you make, obviously. So rate are determined by the number of children. So your AGI exceeds $24,820 for qualifying child. And we have an IRS table that I'm going to show you that shows how we phased out. Oh, I think they're going to show us. Okay, wait a minute. So this is for married people with a qualifying child, okay? And then if we go forward, it's also available for people with no kids. It only is for people 25 to 64 who cannot be claimed as a, so any idea why it starts at 24 and 5 and ends at 64?
Medicare, 65.
Medicare hits at 65, but what else is in that?
The deduction for children end at 24.
Well, you can't be a dependent anyways. What were you saying, Doris?
It's like a lot of times with kids over 24, it's like they're in college.
Right. They're not supposed to be making any money, right? And over 64 or 65, you don't have a lot of earned income anyways because you're on Social Security and you're getting a pension. So your earned income is going to be low. So you're not to be getting this when you're supplementing with unearned income. So that's not the target audience. So the credit for a married couple filing jointly with no children would be 7.65 times the earned income up to a max. It's phased out at $14,000. So you can't make more than $14,000. That's phased out at the max, all right? So for married people, $8,650 is the max for a single person. So that person that I mentioned, we went on for like 9 months after, she made less than $8,650. Exactly. You can't even fathom it, right? A married with no kids. Now phased out when earned for AGI exceeds for a married couple. So a married couple can make $14,000 and one individual can make $8,650. It is hard to imagine.
But that's an adjusted gross, so if she had her standard deduction and was earning over 20,000.
Standard deductions after. AGI is before. So there's very few things that bring that baby down. You see a lot doing VITA. You see a lot of low incomes doing VITA. All right, so if you look at that document that I sent, so it just asks about your kids, the Social Security number, the year of birth, if they were under or over 24, and then if they were permanently disabled. All right, if you're disabled, they can be claimed for this longer. All right, and then you could also possibly claim it for a child that is a qualifying child, depending on what the child, how the child is a qualifying child. Now, if you look at Chapter 13, you don't have to. I will for you. I know. How long have they lived with you? Oh, I don't know. I was just going to tell you the... Here it is. I'm just going to show you the other rates, just so you can have a idea. Oops. And it looks funky. All right. So here are the rates for 2019. So you can see it says no children, base amount, and then the credit, the maximum credit. If you have one child, 2 child, 3 child, and then the credit amount goes up. It talks about the base amount and then the phase out amount. And what, so you can see there for 19, that was, it phases out for no children this year at $14,450. And then it goes up to this year, it looks like 21. So it does go up some. Then it talks about other taxpayers. Oh, that's married, sorry. No children, other tax, $6,900, $8,000. It phases out at $15,000 this year. So it just kind of shows you the maximum income is married with 3 kids, 2 people, $55,592. So if you're married, 2 people working with 3 kids, and you make less than $55,590, you could qualify for some of an earned income. Which I think that's okay. Because if I had 3 kids and 2 people working, I would say that's okay. So that is in the book if you're working, but and you need the base amounts to do a problem. That's in your book. I'm going to leave that there because I'm going to have to pull something up in a second. Okay. Now there's a credit for elderly and disabled. So the general qualifications here are over 65 or under 65 and permanently disabled. All right. The credit amount is 15% of the base, and it's reduced by Social Security. So it's not looking at how much Social Security you're making. It's looking at what do you have outside of Social Security. And there's very few people that qualify for this. All right. So it's a very low income amount that you're looking at. So very few people qualify for this credit, but it's looking at very low numbers in Social Security, very low any income coming in the door. All right, the adoption credit is a nice credit, but for the people that I know that have adopted kids, it doesn't really cover the expenses, but it is a nice credit. So it covers fees, whatever it is, but the maximum is $14,080. It phases out at $211,000, so it phases out gradually as you make more money. The child is one that is less than 18, physically or mentally capable of taking care of himself. Non-refundable credit, but you can carry it forward. So the positive thing about that is I had someone that adopted 4 kids at one time. Yeah, they had been living with them, kind of, but they decided to adopt all 4 at one time. So the credit, they taking $14,000 at one time, it took them below, it's non-refundable, took them below, but they could carry it forward. So they were able to carry the credit forward and take advantage of it. Notice
14,000 per child then?
14,000 per child. Yeah. You do have, when we're doing this in VITA, I constantly have students that try to do this one in the test that try to do it without using the sheet. And I always tell them, you have to go use a tax form. You're not going to be able to calculate this one without using a tax form. They still try to do it anyway. And they get it wrong. So remember that. Okay, remember that. Okay, remember that. So, the reason I tell you that is because if you look on this form, it asks you who were the child care providers, and you can list multiple care providers, and then it asks you who got the care. And the most important thing as you're going through this is the number that you put in for child care expenses has to match the number that you put in that you paid to providers. And I know sometimes people are like, well, it can't. Like, you got to make sure those matches. And it has to match to the penny. So if you're putting in 23 cents, make sure you put in 23 cents to the other. And then as you total, if you look at line 3, you cannot put in more than $3,000 for one kid and $6,000 for 2 or more kids. So sorry if you have 4 kids, like my friend who adopted 4 kids. Luckily they were older. But you cannot get more. And the reason you need this form to do it is because of this right here on line 8. Those are the numbers you need in order to do how much credit you're going to get. A lot of people, if you notice, once you're over $43,000, you get a 20% of the amount you paid. So if it's $3,000 or more, you get 20% of $3,000. It's phased out. So it's pretty easy, but of course on the test for VITA, they don't make over $43,000, so you have to make sure you know what amount to use. All right, so then you use that number and you carry that over. Now that's a dependent care. That's different than the child credit. And then you carry it over on the back, and sometimes there's something to go on the back, sometimes there isn't. So that's dependent care versus child tax credit. And that is also listed on page 12, 13, 15. But if you have that form with you, those have the numbers that you need. So you need to be sure that you know how much money you have, because you need to know what your threshold is. All right, so it phases out when you exceed $400,000. This is a new number. This used to be a lot lower. So they did up this. All right, $400,000 for married, $200,000 for under. Oh, wait a minute, what did we jump to? No, I actually talked about the wrong one when I read this one. So let me back up. I was talking about dependent care when I handed you this, so I'll keep talking about dependent care, and then I'll match up the slides in a second. So dependent care is a couple things with it. You have to be working. You cannot have dependent care expenses when you are a stay-at-home mom or dad, all right? You cannot have dependent care expenses if you choose to go volunteer. You can have dependent care expenses if you work part-time. So mom can work part-time, dad can be full-time, you can have dependent care. You can have dependent care if you're at school. All right, that does qualify now. So that can be a deduction on there. But you do have to be working. If you're married, the spouse has to be working if someone's in school. All right, so you do have to have that on there to deduct those expenses. So I will bring up the thresholds on that in just a second since I messed up and was talking about dependent care. See how I kept saying it's not one? I did it. Okay, so child and dependent tax credit. The dependent tax credit is new as of the tax laws of 2017. It used to be $1,000 per kid, period, and then there was a cap. And the cap was very low. A lot of people did not get the child tax credit. So now the child tax credit is $2,000 per kid, and they added a $500 dependent, and that's what threw me off when I saw that word, dependent care. So anybody that's over the age of 17 or 16 and is in school, you can get a $500 credit for. But they have to be a U.S. citizen and they have to be on your tax return. This is $200,000 if you're single and $400,000 if you're married. And that was a gigantic jump. I think it was like, I want to say like 110 and maybe 160 or something like that, and you lost it before. It was very low. Now, part of this is refundable, and it's called and it's basically 15% of the earned income in excess of $2,500. The dependent tax is not. So basically, my older two kids, if I qualify, would not be refundable. Now, depending on your income, there is also something called the additional child tax credit. That requires a form. All right, the child tax credit and the dependent care credit does not require a form. But the additional child tax credit does, and that is based on income. You can see that one is 8812. And I'm going to show you when we're done with all these wonderful credits, where they go. They all go very close to each other on the form. All right. And so it just depends on how many kids you have. It's going to ask you your income. And it's a very simple one-line form. And then you'll figure out if you qualify an additional amount for the child tax credit. All right, so here's my dependent care. So they're right next to each other. So that's your $24.41. For dependent care, you have to be under the age of 13. Once you're 13 years old, the government decides that you are able to take care of yourself. So you do not need to have dependent care. Unless you are physically or mentally disabled, and then the dependent care can continue on. Eligible costs, it's 20 to 35% depending on your AGI. And like I said earlier, you do have to be married to be able to get this one, too. You cannot be filing jointly. So the costs are basically what it costs to take care of the kid outside of the home. If it's outside the home, mental or physically incapacitated dependent must spend at least 8 hours a day within the home. So there are a few different rules if it's a handicapped individual. I already made a comment that it can't be more than $6,000 for 2 or more kids. It said amount of eligible costs cannot exceed lower of the taxpayer's or spouse earned income. So basically you can't put more $3,000 in there if you only made $1,500 working. All right, now that's one of their limits. And then full-time or disabled spouses are deemed to have earned up to the maximum per month limit. So I mentioned student worker or students can qualify for it. You can also qualify if you're disabled. So if a husband's working, spouse is disabled, you can take your child to daycare. And they're able to do the maximum per month. So you can do $3,000 a kid or $6,000 for multiple kids. All right, we're doing good? Move on to my next one. this is the education credit, which is a big one. So I would expect most of you want to know how to do these. Of course, they are phased out because what fun would that be if they weren't? All right, there are 2 different credits. There's always been 2 different credits. They just used to have different names. All right. It used to be the Hope credit and the Lifetime credit, and now it's the American Opportunity credit and the Lifetime credit. So one thing that you will get to get this thing started in the first place, you should get this from every school that you go to. All right. Now, I will tell you, not every school mails them out anymore. Every tax season, we're sitting here doing taxes in VITA, and she's like, oh, I didn't get that. I didn't get that. I'm like, did you log on and try to print it yourself? And they're like, no. Because every school is now electronic with most of their stuff, every student should be able to go online themselves and print it. Not every parent can go online and print it, because unless their child gave them their login ID, which mine has to print theirs, then they're not going to be able to. So people go to get their taxes done, and they don't have this. Depending on their income, this is a big difference. The child doesn't claim it. The child cannot claim this for themselves. Even if the parent, you cannot claim this credit until you're over 24 years, one of them. I'll have to remember, when we go through, I'll have to look at it. Lifetime, until you're over 24. So the parent claims it. So you want to take advantage of it. If the child's paying for their own school, then the parent can claim it and give them their money back. But the parent needs to claim it. So what you're looking for here is the school. All right, the EIN number is important. They want to see what school that they're going to. And then payments received from the school. They actually used to put numbers in box 2, and it really confused people because they were not always the same. So they took that out. All right, so payments received from the school. If there was any adjustments made, you need to put that in. That means maybe it was $4,000 last year, but then something happened. You didn't take a class, they refunded money. They got to put that back in, so you have to put that there. And then scholarships and grants. So if this is $4,000 and they got scholarships of $2,000, you got to put that down because you can't take it for 4. You only get to take it for 2. So you got to put that on there. And then a couple other very important questions. They ask if it includes anything for next year. Right? A lot of times that's marked, sometimes it's not. It's going to ask if you're at least a half-time student and if you're a graduate student. Graduate student doesn't matter, but you can't take the American Opportunity. And then at least a half-time student, you need to be a half-time student to take the American Opportunity. Lifetime, you do not. All right, so that's where you're going to get your information from. It's called a 1098T. It's called a 1098T. All right. So the Lifetime Learning Credit or the American Opportunity, you want that form. All right. Both are related to tuition and expenses. All right. Books and materials and like that are available for the American Opportunity, but not Lifetime Learning. All right. So books, computers, and all your other supplies you can use for American Opportunity, but not Lifetime Learning. You can never use room and board. The thought process here is, if you weren't in school, would you have to have room and board? Yes. So they're not going to let you deduct room and board because you're in school. Unfortunately, it's a little bit more expensive when you're in school, but that's the thought. That's the process. Okay. So then the next is how much of the credit is there. All right. Well, American Opportunity is a better credit. All right. It is for the first 4 years that you're in school. It doesn't matter what age you are, but it is the first 4 years you're in school. So if you decide not to go to school till you're 30, it's the first 4 years. It's typically what they're looking at doing is freshman, sophomore, junior, senior is what they're looking at. Okay? And the maximum credit for anybody is $2,500. So that's the maximum. But if you think about it, that's $2,500 coming off what you are going to pay directly. It's a pretty easy calculation because, and I'm going to leave this up here, it's 100% of the first $2,000 you pay. And then it's 25% of the next $2,000 of expenses. And it gets you right to $2,500. So you only need to spend $4,000. That's pretty easy to spend, all right? So you can almost do that here full-time. And I don't even know if you can't do that here full-time. But at the lower rates, if you're taking 15 hours, I think you can do that here. So, or close to it, okay? And then lifetime learning is just 20%, which you can get up to $2,000, but it's 20% of your cost. So for example, and it's up to $10,000, which is 20%. So for example, when I got my master's, I took lifetime learning. My master's was over $10,000, so I got $2,000 a year. But that's not always how lifetime is used. A lot of times lifetime is used for 1 or 2 classes a year. So it might be a couple hundred, and a couple hundred, and that's fine. So it just depends. You cannot use them both, all right? You cannot use them both. If you are in the first 4 years of school, you are using this. After that, you migrate to this. First question a lot of the tax software is going to ask you is, have you used the American Opportunity Credit? Yes. How many years? Okay. I can tell you, doing other people's taxes, if that's your plan, you got to be really specific when you ask questions. Doing VITA, you got to be really specific asking questions. Because sometimes you're like, you haven't used it, and you're looking at them going, what year are you? So you've only been in school 4 years. This is your 4th, you're in your 4th year right now. Yes. And you're going to graduate this year. Yes. And then you're done. Yes. You weren't done last year. No. And you're like, okay. Because there's some people that you just feel like, I know that they've been telling me that. Now, luckily, in the software we're using now, it populates.
So
But
for
we,
year of the American opportunity, do they have to be continually?
no, you can take a year off. You can take a year off. So you went a year, you stopped, you came back, you went a year, you stopped. But you can't go here. What you could, I would not. You really should not be doing this, because the thing is, you're a freshman, you're a sophomore, you're a junior and senior. If you go from here to here to here, you're not really doing that. But you can take a year off.
If a student that graduate 2 years from
Here, right.
community college and then they go to work for a few years
Right.
and then back.
That absolutely, that would be still American Opportunity. Absolutely, yeah. But the software now is nice because it does. So like next year, if someone comes back to do it, it will say that they took 4 years, but we've only been using it 3 years. So it will say it's their 3rd year at least. So it is nice because I forget. Just doing the people that I helped do, the couple friends, I'll forget what year they're in. So it is nice to be able to keep track of that.
So, if you went to college a long, long time ago.
You can't take it.
What's that?
You can't take it.
Can't take it.
Now, you can take lifetime,
Yes.
but it doesn't matter when you went to school. If you've already completed a bachelor's, you cannot take the American Opportunity. You are done. It is meant for the first 4 years of your post-secondary. So you are done with your first 4 years of post-secondary, you don't get it. That's why when I got my master's, I got lifetime. Right? It didn't matter. It was not my first 4 years of school. And if I go and I've taken other classes, and it doesn't matter. So my husband I don't think American Opportunity was out when he went to school, so he took lifetime. But, so if he decided, he only has his associates. If he decided to get his bachelor's, he could take the last 2 years of that. So it just depends on how it works out. All right. It can be any of your dependents, all right? And to be eligible for American Opportunity, you would have to be taking a half a course load. Now, what you read up there is correct. A course load is 1/2 the full-time course load for 1 term. So it does not mean that you have to be going full-time the whole year. It does not mean you have to be taking 3 classes in the summer or spring and 3 classes in the fall. You could actually go full-time 1 term, and that's considered enough. So at least 1/2 the full-time course load for one academic term. 1/2, so you could go 2.5, I don't know what it's 15 credit hours. So you could go 8 credit hours in one term and you'd be considered part-time. That's all you have to do. So you don't have to go, I mean, it's not massive if you think about it. You could, if you get 9 classes in 1 year, you're going part-time. That's what they consider part-time. There's nothing on the lifetime learning. All right, so here's the bummer. All right, phase outs. American Opportunity phases out at $160,000. Now, we've talked in here a couple times about what is considered middle class, lower middle class, upper middle class, all those wonderful things. And we talked about itemized deductions and people that give to charity, and should they be able to give to charity and still deduct it even if they don't itemize. I'm one that thinks that is too low. They've upped the threshold for the child tax credit up to $400,000. Should this be $400,000? I don't know if that needs to be that high or not. But where is the right threshold? Because I know a lot of people who send their kids to school that make more than $160,000 that I still think should be able to deduct college. It's a $2,500 credit, and people are graduating with massive bills. That to me, I just feel like college should be some type of, I'm not even sure $2,500 is enough at any level of a deduction. So there's some states, New Mexico, if you live in New Mexico, you go to state schools for free. State schools, not even the community college doing A+, state schools. And no, we can't all go move there. It doesn't work like that. But, you know, so there's some things that are trying to help. I just think that threshold's too low. And, you know, you get someone who graduates and tries to get a job with a 2-year and gets to close to, you know, has a good job doing an apprentice or something. Electrician is making $80,000. He goes to school. He can't deduct it. It's $80,000. You know, I don't know. It just seems like it's too low. The lifetime learning credit, look how low that is. You got someone who's trying to go back to school and get a bachelor's. They might not have a bad job, but they're married filing joint, or their wife has a good job, and they're trying to go back to school. I don't know. Just trying to do it. So these did not change. That was the one thing I was looking at. These did not change when the others upped. So that was also something that was a little surprising. The other income levels went up, and this did not. And these are eliminated, too. They're not phased out. That's the eliminated amount. So the American Opportunity is 40% refundable. So if you get it, 40% is refundable, and the entire credit allowed may be offset against any AMT. There isn't any AMT at these levels. All right, AMT is up now. What did we say it was? It was up at 400 and something thousand. So AMT will not be a concern with this. Okay, so the big picture, let's take a look at this. They're making $158,000. Do they make too much money? Just barely. All right, they're under it. Just under it. All right, but they begin phasing out at 80, so they're going to be phased out. I mean, part of their money is going to be phased out. All right, so they're both full-time students. So they paid $7,500 tuition, $8,500 for room and board, $8,100 and $7,200. So the first thing we know is room and board does not count. So we're going to figure out how much. So the tuition they each can claim $2,500. And the reason we know that is because I already told you that if it's more than $4,000, you get $2,500. That's the easy way of looking at it. And both of their amounts were more than $4,000. So they each get $2,500. If they qualify, they can get up to $5,000 of the American Opportunity Act. All right, but we know it's going to be so it said now assume that their AGI is $172,000. Now they don't qualify at all, right? And the other one, notice I don't like the fact they didn't show you how it's phased out, but it would be phased out. They'd get part of that $5,000. They said they are eligible to claim 2000 American Opportunity Act. Now how? So what they do is the $5,000 must be reduced because their AGI exceeds $160,000. Oh, wait a minute. Did I read the wrong? Hang on. Let's go back. Oh, okay, we read it wrong. It's completely eliminated. It starts to phase out at 160. I apologize, I read that wrong. So, they do get the whole 5,000 here. Now that it's up to 172, we have to phase out the 5,000. So that makes more sense why they didn't show us. So, they're going to be able to claim some of it. So their 5,000 must be reduced. So how do we figure out the reduced? Well, it's based on a ratio. All right? You're going to take the fact that you take the 172 that they're making, subtract the 160, which is the base, and divide it by the 20,000, which is going to be the range that they're in, and it's going to be a 60% reduction. All right? So that's going to give them 40% of the 5,000, which is $2,000.
Where did that 20,000 come from?
I'm going to tell you that answer in 1 second. It's the base amount, but now I got to remember where they came up with the base. Give me a second. Da, 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 da. Oh, I skipped the savers credit. If you look at page, all right, so that was page 13, 17, but it's a set amount. So if they were single, divide by 10, if they're 10,000. If they're married, divide by 20. So it's a big reduction, but it only goes up to 180, right? So they're more than halfway to the reduction amount. All right, now go back again, and let's look at it. And Tom and Jennifer have a modified AGI of 130,000. Tom's going to school to part-time graduate. He had tuition and fees of 4,000. All right. So what would he be looking at? As Tom's modified is below 160, he cannot get a $5,000 American Opportunity Credit as the other ones were. So Tom, they got that already. So that's available to Laura and Sam. Tom can get something else because Tom is a separate dependent. All right? So you need to look at that. In addition, he can qualify for the lifetime learning. So you can get the different credits for different people, but you can't take them for the same person. Okay? So he has $4,000 times 20%. That's just a flat 20%. But he has to be reduced by the amount because it starts phasing out at 116,000, and they made 130. All right. So again, the phase out range is 20. You have to take that limit. It's limited by 14,000, and the phase out is 20. So you're going to reduce it by 70%. So they're only going to get $800. Of the $800, sorry, they're only going to get $240. So they're going to add that $5,000 for American Opportunity and $240 for lifetime. So the credits actually go on the same line, which I'm going to show you guys here in a second. But you can get the two different credits as long as they're for different people. You cannot take the same credit for the same person. And then here's the retirement plan. I mentioned that if you qualify, if you're retired and you're lower income and you put money away, you can qualify for a maximum $1,000 credit. You have to be at least 18 years old, and you cannot be someone else's dependent if you're saving. Okay, the last little bit, which I'm not going to go into details because I want to show you guys a couple other things, just talks about payment procedures and how estimated payments are made. And estimated payments are on your final project and how things are paid. And I just want, as you go through this, take a look. It just talks about Social Security, what the 2019 rates are for Social Security. It's now $132.9. It's up from $125. Okay? Remember, we pay 6.2. Your employer pays 6.2. And that's up to $132.9. We pay 1.45 for Medicare. Your employer pays 1.45 for Medicare up to whatever in the heck we make. All right, so it never stops. If you pay more into Social Security than over $132.9, it gets refunded.
So if you're self-employed, you pay double?
You pay double, and then you get to deduct half of it back, yes. All right, W-4s, W-2s. They've gotten a little bit easier, like the state of Missouri doesn't even let you pick anymore. They pick for you based on your federal W-4. Estimated payments should be made if you make more than if you owe more than $1,000. I am cracking up to see what happens this year because so many people owed money last year. I didn't make estimated payments. I owed so much money last year. But I didn't make any because I don't plan on owing this year. So if I owe again, I'm probably going to get a penalty. But because if you owe more, first year you don't get a penalty. Second year you owe again, you will get a penalty. All right. And then it just goes on how you can come up with to avoid future penalties. And I didn't pay any of this. Okay, and then it talks about self-employment and how you want to go through that, which you guys should have worked those forms. And then the Affordable Care Act. And there is an additional tax on Medicare. All right, it's 0.9 for higher income individuals. That was the last couple of years. And then it's 3.8 on, I'm drawing a blank, sorry. It's 3.8 on Medicare for those unearned income. I knew it was something. All right, what I just handed to you is a summary of all tax credits for Chapter 13. So just kind of a nice little summary of everything and what section of code they're talked about. So it doesn't necessarily tell you where to go in your book, but if you're wondering if it was covered, if you read something, it will tell you it's there, and you'll know that it is actually in Chapter 13. So I'm going to put up now, I never remember if it's 1 or 2, it's 2. So here is your 1040, and it's not straight, that's going to drive me crazy. Here's your 1040. The majority of your credits here's your child tax credit and credit for other dependents, right here. Here is your refundable credits, earned income credit, Schedule 8812 and 8863, which I just gave you guys both. All right, 8812 was the one that was your last one. That was additional child tax credit. And 8863 I gave you earlier. That was the one. What was 8863? Yes, American Opportunity. No, yes, American Opportunity. Now, dependent care is going to go here. And then there's two other forms that you could, two other items that could also come into play. Schedule 5 has several other credits that could come in here. All right, those credits that could come into play, and those are, I didn't print them, I don't think. They come from like the retirement credit and energy credits and other credits that would flow to this form, Schedule 5. They're not very common. The other one was Schedule 3 and dealt with credits that could flow through there. But for the most part, the major credits come through directly to where I just showed you on those lines on the 1040. And if you notice, and Schedule 5 actually says payments and credit. But if you notice, your AGI was here, your standard deduction, your taxable income, then your tax. So here's how much money you owe on line 11. Then your child tax credit. Then how much do I owe? Right? Then other taxes that you might have owe. Then total tax. Then federal tax. Okay? How much do I owe? Federal income tax withheld. Then refundable taxes. So this is what you get even after you might not owe anything. So those refundable taxes are earned income credit, what you can get from American Opportunity, and what you can get from the additional child tax credit. So American Opportunity is also going to be up here, all right? And yeah, right up in this line too. All right, so they're going to be here if they're refundable, and they're also going to be over here. So it just depends on whether they're refundable or not. So it's section 5 or schedule 5 now is also gonna have some of that in 3. So it just depends on refundable or not. Now, the in-class exercises should be pretty, now, the first one was a general business credit, so I wasn't really looking at that one. But look at number 2. I'm gonna have you guys do that, and then if you wouldn't mind after that, I'm gonna have you guys do the wonderful little survey. And then we'll be done.